But let's bring it back here. Talk about this rally that we got, Rob. We're winding down the first half of the year. Again, we're on Apple Watch, IPO Watch. What are you watching?
Well, you're watching the IPOs, right? You saw 41 billion come in 21. You saw 2 billion come in 22, 7 billion year to date. So that looks like there's a bid to the market. You've got Steve Weiss yesterday talking like he's Jim Lebenthal, right? I mean,
he's got a long way to go.
He's still pretty cautious.
That's a little different. So in the short run, I think there's a bid to the market. There's no question about it. I think, we've been saying that you got to stay invested, but cautiously. And it's not an everything market right now. You need to have portfolios that reflect, even though it's been delayed, the possibility of recession risk. And how do you do that? You focus on quality, and over the intermediate term, you focus on valuation. And so I think it's a really difficult time because we don't know if this economic strength is going to lead the Fed to ultimately make a mistake. Possible, and we don't know when the market's going to wake up to the fact that technology stocks are linked to interest rates. They have been historically, just not year to date. And at what point in time does this AI enthusiasm fade? And I think we're in a sweet spot right now where you have the tailwinds of these companies that can weather a storm with the cash that they have, and you also have a broadening out in the market technically.
Yeah, I'm glad you went there, too, because we do have, Jimmy, a pretty broad move. Materials having a good day today. Financials on the back of the stress test results having a pretty good day. Industrials are up 2/3% as a sector. Utilities green, energy green. Tech is green, albeit modestly.
Yeah, no, this feels like a good day for somebody who's positioned like me, more in cyclicals. You see the equal weight S&P 500 outperforming the NASDAQ. You see small cap rallying. And why is this? I hate to focus on one data point, but jobless claims coming in meaningfully below expectations. That's the most near-term indication of the health of the economy that we've got. I'm not going to mention GDP for the first quarter because we're at the end of the second quarter, but jobless claims are indicating that there is strength continuing to this market. And if that's the case, the recession gets pushed further out or maybe even gets negated. That's why you're seeing the broadening of the rally, which helps me in my positioning quite a bit. Scott, I want to go to one data point that may seem a little esoteric, but I pay attention to what's going on in Las Vegas because it's the hyper-discretionary spending, right? Whether it's consumers or corporations. Just today, we got the Las Vegas Visitor and Convention Authority figures for May. Now, they do it with a lag. I'm sorry that it's for May, but what you're seeing here is that all the important figures, RevPAR, revenue per available room rate, occupancy, are still at January levels. Why is this important? Because, Scott and our viewers, remember, it was March. We had the regional banking system kind of collapsing in on itself, and everybody said, Senior Loan Officers' Opinion Survey, we're going to see more unemployment. We're going to see a decline in discretionary spending. It's here in May. We're just not seeing it.
So I'm glad you bring it up. It's a perfect segue, Steph, to you. I teased at the top of our program, the very top, about a committee member who had a number of moves, and you are the one that I was obviously referencing. Let's just start, since Jimmy went casino, let's go casino. You bought Las Vegas Sands, LVS. Tell me why. And there's a number of things to get through, but this is the first one I want to talk to you about. New buy.
Yeah, well, this is my conviction in the China reopening play. 40% of their total revenues are in Macau. 60% are Singapore. So this is not a casino U.S. play. This is the Asia markets that I think are poised to recover. And why I chose Las Vegas Sands is because I think even though the stocks had a nice run and they had a great quarter, in their quarter they beat earnings, they beat revenues, yet 31% of their hotels were out of service. 27%, you only had 27% of ferry capacity and 39% of airport volumes. My point being, things are still depressed over there, and I think you will see upside as a result going forward.
Yeah. By the way, Savers is open. You probably heard the bell as Steph was talking. You saw that stock was up. If we can see the chart so I can see exactly what it's doing right now, please. Steph, I'm going to come back to you in just a second, but I do want to see where it's open. And it was a nice move off the open there. So anyway, we'll continue. There it is. It's up 36%. It's the first of three here on the floor of the New York Stock Exchange today, which is a big day down here as the great thaw of the IPOs continues. So, Steph, forgive me. Let me come back to you. Again, continue with Las Vegas Sands. Why you did this, a pure China play, it would seem.
Right. And so the first quarter was better than expected, as I mentioned, and things are still depressed. But their color commentary about March was really interesting to me. Visitations in the month of March alone was up 22% in Macau, and occupancy grew 800 basis points. So again, you have some momentum building. You still haven't felt the 100% effects of the reopen. I think we're in early innings, Scott. And you know that's been a theme for me. I haven't been right year to date. We haven't seen liftoff yet in China, but I do think it is coming, and so I still want to stay on that theme.